Hey traders, Jason here from Leavitt Brothers. In last week's video I talked about how the worst was probably over, and even if the market retested the lows or took out the lows, limited additional damage would be done. But just because the worst is likely over or close to over doesn't mean the market is about to rally to new highs. Okay, this is what I'm going to talk about today. Is the current bounce, which started last Friday, just a bounce within a newly formed downtrend? Or is it the beginning of the market's next rally? Okay, nobody knows for sure what will happen. But I'm going to discuss some of the indicators I look at that will help guide my way. Okay? Here is the S&P 500 versus the 10-day moving average of the NYSE advanced decline line. Okay? When the market is healthy, a characteristic of a healthy market is that the advanced decline line fluctuates up and down above zero, mostly above zero. Okay? And so as long as it does that, the market is generally healthy and it generally trends up. When it dips below zero by a moderate amount, kind of like what it did last March, you tend to get a flat period. As you see here, it dipped again in August, you got a little flat period. Dipped again in November, you got another flat period. Okay, so obviously we got a big dip. It's the biggest dip in a long time. So for me to believe that the current bounce has legs and is going to continue up, I'm going to want to see the 10-day of the 80 line get above zero. Okay, it's actually pretty simple. If it moves up and gets rejected and goes and starts to go back down, the market is likely to follow. But if it can climb above zero and stay there, then hey, maybe this thing has legs. Maybe we can go a little bit further than some people think right now. Okay, backing up a little bit, here's the cumulative version of the chart on a weekly basis. As you can see, it's still trending up. It's still got a pretty good distance between itself and the 50-day moving average. So as of now, the long term seems good. Okay, so that's why my opinion right now is that the long-term market is in pretty good shape. It's the next 2, 4, 6 weeks that are more in question. Okay, next chart. This is the S&P 500 up above versus the 10-day moving average of the NYSE 80 volume line. Okay. The advanced decline line gives equal weighting to all stocks. It doesn't matter if you're a multi-$100 billion company or a small company, you get equal say. The 80 volume line gives allows more influence for big cap stocks that trade a lot of volume. Okay, you tend to get the same picture, but they can vary a little bit. But what I look for here is similar. Okay, a characteristic of an uptrend is when the 80 volume line is moving up or below or above zero, okay, and then deeper penetrations below zero tend to be associated with flat periods, as you can see here last August. So obviously we got a big penetration of zero, dropped all the way to negative 300, now it's climbing. So for me to believe that the current rally has legs, this needs to get at least close to zero, more likely above zero. And if it can do that, then I'll believe that, hey, this might be the beginning of a rally as opposed to just a bounce within in a downtrend. Okay, so I'm not going to make any predictions, but I'm just going to lay out the groundwork or the framework for what I'm looking for. This needs to get up to zero, or else the current bounce is probably going to fail and go back down. And here's the cumulative version of that same indicator on a weekly basis. Obviously, it's trending up really well. It trended up for 2013, 14, beginning of 15, above its 50-day, rolled over, and it's been above its 50 since like the second quarter of 2016. It's got a nice buffer to work with, so the market could leg down again, and this indicator could stay above 50 of its 50. So for now, my opinion is that the market's in good shape overall. Okay, this indicator's trending up. It's got room to move to take on a little bit more heat. Overall, it's doing well. So long term, I think the market's in good shape. It's the shorter term, next, as I said, the next 2 to 6 weeks that are more in question. Next one, S&P 500 versus the NYSE new highs. Obviously, when the market moves up, you tend to get steady prints at an elevated level from new highs. Okay, they don't go really high, but if you get steady prints between say 100 and 300, that's good. That's a good environment to be in. If you just get steady prints, not too high, not too low, just kind of steady prints in the middle is the best case scenario for a trend. When you get low prints, the length of time that the low prints stay low tell you approximately how long the market's going to pause. Okay, so you go back to March and April where you had almost 2 entire months of low prints, and that led to the market being flat for a couple months. Okay, you go to August, same thing. You had an entire month of low prints, and you got this pause. But in November, you got a couple of low prints, but it was short-lived, so the pause was shorter. Okay, so what I'm looking for right now is I want to see how long do the low prints persist down here. Okay, if low prints persist for a long time, then the market is probably just going to bounce around and move sideways. If the new highs can start to move up, then that's an indication that the market's gaining more strength and is probably going to continue up. Okay, that's what I'm looking for here. I'm not going to guess, I'm not going to predict. I don't know what's going to happen, but for me to believe that a rally has legs, new highs are going to have to eventually expand. Another one I look at is the high-low differential. Here's the S&P 500 high-low differential down below. High-low differential is just new highs minus new lows. A characteristic of a strong uptrending market is when you get new highs, when you get the high-low differential oscillating above zero. Okay, it moves up, it moves down, it moves up, it moves down. That tends to be what happens during an uptrend. When you get penetrations of zero, the market tends to pause. When you get steady prints at zero, the market tends to pause. And when the market is when the indicator just kind of oscillates up and down above zero, the market tends to be in good shape. Obviously, we got a huge negative print in the last 2 weeks, but now we're almost back at zero, which is good. Okay, right now new highs and new lows are at low levels, so this indicator sits right near zero. For me to believe that that the current rally has legs, we're going to need to see this indicator get above zero and stay above zero. Simple. Okay. Again, I'm not going to predict. I'm not going to guess. I'm not a fortune teller. I don't know the future, but I'm just telling you what the framework is I'm using. If the market's going to move up from here and continue, this indicator is going to need to get above zero and stay there. Okay, and here's the cumulative version of that indicator. It's trending up nicely above its 50-day moving average. It's starting to get close to its 50. It's fine. As long as it stays above its 50, the long term will be in good shape. As you can see back here in 2015, when the indicator took out its 50, that was the beginning of a long consolidation pattern. Okay, you can see here in like June, July of 2015, the market was at 2100. You can go June, July of the following year, the market was still at 2100. So the fact that this trended down below its 50 led to the market trading flat in a consolidation range for an entire year. Okay, so for now we're in good shape, but if this thing rolls over and goes through its 50, then we may have a longer term consolidation period ahead of us. Okay, a couple more charts. Down below is the S&P 500. Up above is the percentage of S&P 500 stocks above their 20-day EMAs. Okay, characteristic of an uptrend is when this indicator oscillates above 50%. Okay, it tends to move between 50% and 80%. Okay, goes up, goes down, goes up, goes down. That's above, as long as it takes place above 50%, that's a characteristic of a strong market. When you get a penetration of 50% and you get like an oscillation between 30% and 50%, that tends to lead to the market pausing. Okay, not a big deal. The market moves up, it pauses, it moves up, it pauses, it moves up, it pauses. That's pretty normal. Okay, so obviously we got a big penetration in the last 2 weeks. Now we're sitting near 20%, which is fine. Eventually, if the market that's current, I don't want to call it a rally, but if the bounce that's currently playing out is going to have legs and going to last, we're going to need to see this indicator get above, climb back up above 50%. Okay, if it climbs back up, gets rejected, and starts heading back down, the market's not going to go anywhere. Okay, it's mathematically it would be impossible for the market to rally for any length of time if such a high percentage of stocks are trading below this moving average. It just can't happen. Okay, it could take place for a short period of time. Okay, because you can have some big cap stocks that are like pulling the market up, but the market needs to have broader participation in order for a rally to last. And right now, it's not happening. So again, I'm not going to predict anything. If the market's going to continue up, I'm going to want to see this move up to above 50%. If it doesn't happen, market's not going to go very far. One more. Okay, similar concept. S&P 500 down below. Above is the percentage of S&P stocks that are above their 50-day moving average. Same thing. Okay, when the market is healthy, this indicator oscillates above 55%. Usually goes between 55 and like 80, 85%. When it dips into the 45 to 55, 60% range, that usually associated with a pause. Again, market moves up, then it pauses, it moves up, it pauses. It's all very normal stuff. We got a big penetration here. Now it's trying to climb back. Similar to what I just said, in order for the market to have legs and can continue going, we need a greater percentage of stocks trading above their 50s. If it doesn't happen, the market's just not going to go far. Mathematically, it just can't happen for the market to trend up when you have 70-something% of stocks trading below this moving average. All right, that's it. Come check us out at Leavitt Brothers. Okay, we find the best stocks in the best groups. We profile them and bring them to your attention so you can make money. Okay, you still have to do some of the work, but heck, you can start each day and each week with a really good list to work from. Okay, at leavittbrothers.net, our weekly report, which discusses the long and short-term trends and the staying power of those trends, is only $149 for the year. Okay, our sector breakdown and trading ideas report, which offers many new trading and investing ideas from the market's leading groups, is only $299 for the year. One good trade pays for your subscription for an entire year. Come check us out.